Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, social media, see what people are sharing. I'll interject my financial opinions as we go, generally related to wealth building, commodities, and/or financial topics is what we cover and what I like to make my opinions on. So let's dive in there. Let's see what's going on. You can follow me at funding_finance, and you can join our community if you like at finding-value.com, where I dive deeper into these sectors, individual companies and sectors out there. I also share what I'm doing with my portfolio, what I'm adding, and whatnot. Starting with Isabelnet. Recession. The probability of a U.S. recession in 12 months calculated from the yield curve stands at 55.1% in April. So we've got the probability of recession calculated based off the yield curve. And there we are. And you can see the probabilities as they go up and down over time. And you can see that some of these cycle up and down over time based off of the yield curve. But where we are today, pretty high percent of probability in relationship to history. We had that also in the early 80s, again in the mid 70s and early 70s. In terms of percent probability of recession off the yield curve. Coming down, investment wisdom, John Templeton. The only way to avoid mistakes is not to invest, which is the biggest mistake of all. So in order to avoid smaller mistakes, not investing at all, which is the biggest mistake. Fix the Fed. Hyperinflation happens slowly at first, then all at once. Japan has been begging the U.S. to allow them to intervene more and sell more United States treasuries. The U.S. was refusing because it knows the consequences for our markets. 160 is the proverbial line in the sand, but it may already be too late. And that's the Japanese yen. And that's why perhaps we're seeing the dollar continue to go up, is because we are comparing it against toilet paper. The Japanese yen is one of those currencies that we are comparing against. So we are comparing it against weaker currencies, much weaker than ours. And that's one of the reasons that the dollar remains so strong. Here's the Headless Horseman potential proxy here. And what we're looking at is this is, let me see if I can shrink this down a little bit. I've got such a big chart here. It's a silver company, and we've had big move up in 2016, consolidation for about 4 years. Big move up in 2020, we've got a consolidation for about 4 years. And here we are moving higher again, and maybe this is a precursor to a much bigger move. You can see he's got these circles here, but they are fractals, kind of a move off the bottom, consolidation, and then a big, large move higher. You can maybe even run a off the tops here, and maybe we're going to come way up here where we have a trend line going across here. But that's a possibility for, this is a silver company. I can't read the name of it, Defiant Silver. And we could get a big move there. It makes sense from this 4-year cycle that he's got there. Game of trades. This is a very concerning chart. Bonds have broken down from a 40-plus year uptrend. While a bounce is very likely based on technicals and potential Fed rate cuts, high levels of debt and high inflation are going to lead to a much deeper downside this decade. So he's in the higher for longer camp. He's got a potential move higher where we see a slowdown in the market. People move into bonds. And then we see another inflationary move where bond prices go lower again and rates go up, is what he is projecting. What if the HUI is an 8x from here, where we go back up to the top of this trend line here? It very well could. And I think that's probably highly likely. Highly likely. Tracy says, This may blow some minds, but Norway's oil demand hasn't crashed despite record EV market share. The fact that a record 90% share of all new car sales in Norway are electric has failed to make any impact on the country's oil demand, indicating that hopes of rising EV uptake making an immediate dent in global oil demand are unrealistic. Road fuel demand in Norway has remained relatively stable even with soaring EV adoption, raising questions about whether EVs really have a material impact on diesel and gasoline sales. Rystad Energy said last year. The lack of a noticeable dent in oil demand in a country where EVs are 90% of all new car sales is a cautionary tale for those predicting an immediate drop in oil demand due to rising EV sales, according to UBS. So that's real interesting there, guys. They have 90% of new car sales and they cannot make a dent in the country's oil demand. Why are we even mandating these things if they don't have the intended outcome, is what I'll say. Scrolling down, Katusa Research, a kind of race is going on. Despite gold's breakout and copper hovering at all-time highs, copper mining stocks are outperforming gold mining stocks. So copper miners versus gold miners, and copper miners, at least in the short term, have been outperforming since April of 2023. Patrick says we have a macro paradigm shift unfolding before our eyes, something that very few of us have ever seen before. So be ready. So this is personal consumption expenditures. Up, 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 up. And then looking down at the rate of change that he has here, he says it's been going up since 1959, but its 7-year rate of change is reaccelerating like it did in the 1960s and 1970s. So the 60s and 70s had a pretty big personal consumption expenditures of rate of change. That rate of change changed in 1980, came all the way back down to a bottom in 2020. We recently broke out of a downtrend line on rate of change, and we've been working our way higher, much like the 1960s and 70s. Just an FYI. The yen is crashing, just blew through 157 against the dollar. Why? In part because U.S. yields have been climbing due to reaccelerating inflation. The Fed embarked on the fastest hiking cycle in history, and it hasn't worked. They are now desperate to somehow justify cutting rates. In a textbook, the BOJ would simply raise rates here to protect the collapsing yen. However, Japan can't really afford to hike rates meaningfully with a 265% debt to GDP ratio. If they did decide to hike anyway, it would likely send U.S. yields even higher. Japanese institutional investors are the largest foreign holders of U.S. treasuries, who would then be selling to reinvest back in Japan. It's a terrible spot. The Bank of Japan is currently sitting on their hands and watching the yen collapse. That's interesting there. So this is Investment Wisdom, Peter Lynch. Moderately fast growers, 20 to 25% in non-growth industries, are ideal investments in his opinion. We've got Matt Miller here. He says, I just look at the shale production charts like this from time to time and think this is going to be so bad. And no one outside energy understands it. So what we're looking at here is they continue to bring on all of these different areas. This is by year and by quarter. All these different, we'll call it colors, are by quarter. This is the daily oil production for, this is America or shale? Let me see here. Shale, just shale production, I think. You can see that we were growing kind of slow, and you can see slow decline rates all in the beginning. But look at how fast these decline over time as we continue to go up. That's crazy how fast the decline rates are. So this doesn't look all that great, guys. If we have any sort of stumble here, we're going to see quite a bit lower production in terms of shale oil if we don't continue to drill. as fast and as viciously, I'll call it, in the shale area. Shanghai silver versus COMEX silver. We're still at $30, over $30 in China, and we're at 27.68 in America. The metals continue to move from the west to the east. Bill Gross says, avoid tech stocks and stick to value stocks, says Bond King Bill Gross, which is basically what we're doing. We're in the value stocks. Bill Gross says, stick to value stocks, avoid tech as U.S. yields soar. We had on there some data. In the 1970s, we saw technology stocks, which are very sensitive to interest rates because their value is dependent on growth. The more you're dependent on growth in the future, the more you're impacted by higher interest rates. So in the 1970s, the data bears out that technology stocks were some of the worst performing assets because of yields going up and inflation. So money would rotate from technology into precious metals, commodities. Those were the two biggest winners in a highly inflationary environment with increasing yields. So Bill is completely right. Value stocks outperform and tech generally underperforms given the market conditions that he is describing. Silver Institute survey in 2024 projecting the second largest worldwide shortage of silver in more than 2 decades. Well, that sounds pretty solid there for silver. Investment wisdom, Warren Buffett, we don't get paid for activity, just for being right. So they get paid for being right, not about all of the crap that goes into being right. So it's not about activity, it's about actually being right. Here's some high value financial advice from Morgan Housel. Spend less, save more, wait longer, lower your expectations, is what his opinions are. Coming down to Tavi, we got now is not the time to stand in the way of this long-awaited historical breakout, in my view. With gold prices at these levels, mining companies are likely to become true cash flow machines. Newmont's earnings release today was just a glimpse of what's to come, and this is mining stocks to gold ratio that we are about to break to the upside. Huge upside potential in the mining stocks. Let me get this. There we go. Coming on back down. Of course, I went and hit the wrong button there. Coming back down to where we are. Global oil inventories are at their 5-year seasonal lows per Morgan Stanley. So total oil inventories are at the 5-year lows here, just barely hanging on in terms of inventory. We've had oil prices much higher than where we've been, given where our inventory levels are at today. It doesn't mean that right now we're about fairly valued, but a lot of people don't consider the strategic petroleum reserves around the world as inventory. So I'm a little confused on how people view that, but to me, I would view that as inventory. And if the inventory of all those SPRs are drained, by 50% or something, I would be very much worried that oil prices could easily head higher if commercial inventories head any lower. Jeff says this is going to breed resentment. Picture a 35-year-old couple, second baby just born, can't keep waiting for interest rates to decline. They're in a $2,843 per month mortgage payment, total cost payment, we'll call for the house. Next door neighbor, also 35, also 2 kids, same household income, house looks just like theirs, in for $1,400. So homebuyer housing payments are up 12.6% year over year. Mortgage payment on a 4-week rolling average of the median asking price of where we are at today. But that also is a signal of how short we are in the market in terms of homes. If the homes were flooding the market, we would see prices are lower. I do know that the mortgage payments are a huge function of interest rates. I don't think interest rates are necessarily going to go down in the short term and be sustained lower. We could get a pullback. Anything's possible in the short term, but the momentum's to the upside. So I don't think there's going to be too much relief for home buyers and their mortgage payments yet. Not yet. But if we do get a recession, we do get a slowdown, there is a possibility that rates could pull back. There is that possibility. Investment wisdom. It says the true contrarian waits for things to cool down and buys stocks that nobody cares about. That's exactly what I do, and I've just put ratios in it so you can basically use data to objectively say that it's cheap or not. So if something's cheap, you're on out of favor market conditions, you buy stocks that nobody cares about. That's basically what you want to do to become successful. The hard part is people are going to tell you it's a bad investment. You're not in the herd, so you can't really just blend in. You're going to stick out like a sore thumb, and you're kind of putting yourself out there and probably will get ridiculed because you're not in with the herd. The herd doesn't make nearly as much money. They're probably all over in technology stocks right now, like Nvidia and all those types of companies. So, in order to be successful, you basically have to go against all of the herd. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We do have a question and answer session going on right now. So jump on in if you want to join. You can join there's a Zoom meeting link on the website that you can click to join the meeting. All right, guys, that's all I've got for today. We'll catch you later. This is Finding Value.